Welcome, everybody. This is Alex Sanchez. Welcome to our first plan audit webinar. We appreciate you being here on this with us on this Friday. There's a lot of the things that you can be doing on this Friday, so we appreciate you being here with us today. We've got a great group of plan sponsors. We've got service providers on the line, TPAs. We've got advisors. We've got wholesalers. So welcome. I want to give you a couple moments here as everybody's starting to log in to just work and play with your settings. If as soon as you log in, you see us taking up half the screen, definitely want to have a good visual of the presentation. So just slide our video over to the right so you can get a good clear presentation of the slide deck. We've got a lot of good things to cover today. Preparing for your first plan audit webinar, a survival guide. So as I mentioned earlier, we've got a good mix of people that have joined us for the Zoom today. If you're a plan sponsor, welcome. This is really for you. I mean, it's really so for your informational purposes, so you can feel like you can be prepared for this first audit. I know anytime audits are tossed around as a word, people get nervous about them. You know, when people come in and go into your company and start looking at things, only bad things can happen, right? That's what your mindset, your mind goes straight to that, and what could go wrong. But I want to make sure that you are after these 45 minutes, you feel a lot better prepared for this audit, and that you don't feel that way, that we can alleviate some of that stress for you. If you're a service provider, welcome. You know, we're always trying to, as service providers ourselves, trying to increase the tools that we have in our toolkit to be able to service our clients better. So, you know, I commend you for being here on a Friday with us and joining us here. And we hope that you'll have a few more than just one or two takeaways out of this. Quick background on our firm. Again, I'm Alex Sanchez, partner with the firm. I've been with the firm for about 4.5 years, in the industry for 20. I'm zooming in from Florida. Chris, why don't you go ahead and introduce yourself real quick?
Hi, everyone. Again, thanks for being here. Chris Beckett, practice leader here at Pension Assurance. I've been with the firm since 2016, spent a couple years at Deloitte, and then decided early on in my career that I really wanted to specialize in one area related to audit, and that was benefit plan audits. And so I made the transition to Pension Assurance and have been 100% focused on employee benefit plan audits since 2016. I will add too that we do have, I believe, a Q&A question applicable for this. So if you do have any questions at any point in time, I'll be monitoring that, and we can just pause where we're at and answer any questions. And again, we'll have time for questions at the end as well. So I'm calling in from Colorado, so glad everyone's here and hope there's some great takeaways from the webinar. Thanks, Alex.
Good stuff. Thanks, Chris. And so good point. So if you, let's say, have an emergency call or something midway through, or are unable to make the entire 45 minutes, don't worry. We're going to be recording this and providing you with the link to the webinar afterwards. So even if you're worried about taking notes or missing something, or if you have a colleague that you wanted to invite to the webinar that couldn't make it out, you'll have that link to be able to forward it on to them and they can watch on demand. No worries there. So rest assured that it'll be available for you. So one of the things that you'll hear throughout the presentation is traditional firm versus single service accounting, traditional firm versus pension assurance, and how we differentiate ourselves. So wanted to just explain what that was. A traditional firm, in essence, is a firm that is kind of your one-stop CPA firm where you can, go in and they would handle your corporate audit, corporate tax work, consulting maybe, and they have all these services in their service model, right? Many revenue sources. We're a single service accounting firm, so we don't do any of that. All we focus and 100% of our time on is retirement plan audits, right? So when we say single service, as it says on the screen, that is what it is. We really believe in the power of focus, right? We founded the firm in 2014. It was John Russin and Nathan Johnston, who are our co-founders of the firm. They started this back in 2014 by spinning off about 125 plans from a traditional firm, knowing what the future was going to bring, right? The Department of Labor has put on more regulation, the IRS as well. There's been more scrutiny in our industry and pushing for more quality service and quality audits. So with that vision, we just wanted to focus on, retirement plans, and the fruits of that labor have resulted. You see at the bottom of the screen, extensive experience. We audited 760 plans last year, starting with the 125 back in 2014. So in less than a decade, we see this massive growth. We're projected to audit about 850 plus this year, and we're all over the country. We've got people just like me in Florida and Chris out in Colorado. We've got people sparsed out throughout the country. Wanted to share our vision and mission with you all. Really, our vision is to become a national leader in the area of retirement plan audits in quantity, quality, and subject matter expertise. And that's really what it is. And on the mission side, we really want to educate our clients and not just think of this as just a box to check or a compliance thing that needs to get done, but really use this opportunity to educate clients and to improve the audit process, to improve plans in general, and not just doing the audit for the sake of doing the audit, right? So when we talk about the mission, that's what it is: deliver value and education to our clients through our retirement plan audit process by cultivating a team of experts that provides the highest level of service and efficiency. Efficiency matters too, right? We have so many hours in the day to get stuff done. And if you're talking to an HR professional, a CFO, a controller, the 401k is just one part of the puzzle for them, right? It's not, or for you all as plan sponsors, we have HR people, CFOs, controllers on the line. So for you that are on the line, the 401k is just a subsection of what you have to worry about to operate a company or operate, your department. So you want the servicers of your 401k plan to bring efficiency to the table to alleviate some of that stress from your plate. Objectives. What are we going to go over today? Here's the list. We've got a lot to cover over the 45 minutes, as I mentioned, but we want to go over when a plan audit is needed. Why are you here to begin with? Why do we need this audit? Selecting a plan auditor. Many people think that, we're all one and the same as CPAs, but that's definitely not the case, and we'll share about that. DUL audit quality study, which happens every so often. We'll share the stats on that. Documentation needed during the audit. And Chris will also talk about how your plan service providers can help and how we utilize service providers to help make it run efficiently. Common audit findings and the audit timeline. So you get a sense of how long an audit should take from beginning to end. So how did this happen? How did we get here? Why do we need to have this audit completed? It's a good question, and a question that comes up all the time. And so for plan sponsors, you're probably here because you're about to embark on your first audit, and maybe this is all completely new. So we just want to be able to kind of, clear the air a little bit and make more sense out of it for you. So the Department of Labor and its moving components, we've got several things going on this year versus next year. So we'll talk about that. But beginning of year headcount is what matters and what triggers whether you need to file a large Form 5500 or a small Form 5500. So if you're looking at your 5500, on page 2, line 5 of the 5500 is where you start, populating the headcount figures for your plan. And so beginning of year participant count is what is looked at. So as of 1/1 for a calendar year plan, if you're over 100 eligible participants, generally you're going to need to file a large Form 5500, which means an audit needs to take place. But that's the general rule of thumb, right? For most of you that are about to do this for the first time, you've had a plan in place. It's a plan that's been growing. You've been growing as a company. The 80-120 rule is what applies to most of you. So the 80-120 rule, what it says is that if you are between 80 and 120 in the year before, and you filed under a small plan filing, you can file as a small plan filer up until you reach 121 eligible participants. So you can postpone and push that audit off and continue to file as a small plan filer. 121 is the magic number, not 100, right? For that first initial audit. So in example 1, you have a participant count of 118. You filed as a small plan in the prior year. You can use a small plan waiver until you're over 120. Now in example 2, you had an audit done, you're still at 118, but in the prior year, you had an audit done because you had 122 participants the year before. So you've already had audits taking place. And then you drop down, you go from 122 to 118, right? But you're still going to need an audit after that initial audit because you filed as a large plan filer. For you, you have to wait until you drop below 100 to waive that audit, right? And that's based on the current rules as they stand right now. That's how the 8120 rule plays a role in all of this. So if you ever have doubts about whether you need an audit or not, it's always good to get a second opinion, talk to your service providers, talk to your TPA, your record keeper, if it's a bundled plan, just to make sure you're comfortable with your scenario and your situation, and that you're doing the right thing and what you're supposed to be doing. And one major thing that I think, people need to understand is that when you think about a participant at the beginning of your participant count, you might automatically think, okay, well, this should just include people who actually have balances in the plan, right? But no, that's not the case. As it stands right now, eligible participants, if you look to your lower left-hand side of the screen, that participant count by definition includes all active and eligible employees, whether they have money in the plan or not. So you can have a plan where, it's been around, you've got people that are eligible to participate and not participating, and still they're going to be in that count. That just changed completely. So starting as of 1/1/2023, that rule in bold to the lower left, the Department of Labor, the IRS, and the Pension Benefit Guarantee Corporation, the PBGC, as of 3 weeks ago, changed it and kind of shook up the industry a bit. So starting as of 1/1/23, that eligible participant count, now they're going to be looking at active participant balances. So participant balances is what's going to be looked at to determine whether you need an audit or not starting in 23. But as of now in 22, it's this old definition that's been around for a while, where it's based on eligible headcount. So there might be some confusion, but if you've got questions on whether you're going to need an audit this year or next year, always feel free to reach out to us. Just know that the rule is going to change starting 2023. So this rule about eligible participants is just going on through the current year, 2022. Okay, so selecting an auditor, aren't they all the same? We talk about first thing that people tend to do, plan sponsors, is just go straight to your CPA firm and ask them, right, whether they can handle your 401k audit. And out of the goodness of their heart, the CPA might just go out and say, yeah, we can handle the 401k audit for you. But is it going to be the best thing for you? Is it going to be efficient? Is it going to be a quality audit? That's what you have to ask yourself is are they, do they have the specialization to be able to perform this audit or not, right? And so there's questions that should be asked as you're filtering and determining whether you have a qualified auditor in place that can take on your audit. So there's many firms that are leaving the space because of the increased technical, specialized, and regulated nature of our sector. When you're doing a GAAP, generally accepted accounting principles based financial statement audit for a corporation versus an audit under, with ERISA standards, the Department of Labor, IRS, and you're looking at payroll, you're looking at the 401k plan, you're looking at investments. It's a completely different style of audit versus a corporate financial statement audit. So there's been heavy regulation from different avenues coming through. And so when you're just a generalist and it's just a subcomponent of your entire business, you're not going to dedicate as much time as a specialist would who's doing it 365 days out of the year. So many CPA firms are exiting the retirement plan space. And so with increased demand for services, there's been a drop off in supply when it comes to CPA firms out there that have the specialization. So it's important to weave through that, and make sure that you engage a CPA early on in the season so that you're not stuck in the 12th hour trying to get this audit completed just before the deadline. There's DOL inspections that happen for firms, and there's also peer reviews where we have other CPAs come in and do peer reviews of our work. And so when they're looking at our work, they're looking specifically at our 401k practice, whereas other firms might say they do get peer reviewed, but do they get peer reviewed for their 401k, or do they get peer reviewed for their corporate work because that's 95 or 99% of what they do, right? So it's important to know the differences between practices and firms and what they really spend their time and focus and energy on, and where they do their education, and where they spend 100% of their time or most of their time.
Hey, Alex, we got a
Yes.
question related
Yes.
to not that last slide, but the previous one regarding the 2023 rule changes for account balances.
Yes.
Does that include terminated employee balances?
Yes, it does. So all balances in the plan are going to be included in that number. So when you're looking at that and you're looking at your entire census data, you want to make sure that it's populated correctly and in full and complete, or else, you might end up with a situation where you file as a small filer because the TPA is taking your census data for what it is, taking it as, complete and accurate, but then a year or two rolls by later and you have an investigation and the DOL finds out, okay, well, no, you should have had an audit because you're not including terminated participants in this number. So you want to make sure that you've got two eyes on it, that you've got everybody looking at it, that your TPA is asking the right questions, or your record keeper, that your advisor's in the mix as well, and just have everybody involved. If you're doubting it, or if you're at that cusp and you're on that borderline where you're trying to figure out, you're at 100, between 90 and 110, and you're trying to figure out whether or not you're in that space or not. So good question.
Yep. And it's important to note that the major change with that 2023 definition of participant is that it's just removing the active employees that are eligible to participate in the plan but are not participating. Currently, they are included for the 2022 plan year. For 2023, that's the only thing that really changes and drops off. Now you're going to what are the account balances as of the beginning of the year? So, taking a look at the participant detail and saying, is there a participant account for this person? Yes or no, whether they're terminated or active, they're going to be included for that participant account.
Yep. Thanks for clarifying that. That's great. And so, yeah, it's a rule that just changed. So a lot of people are going to be asking about it. And we're all kind of working through that as we speak. The other thing to note is that the 80-120 rule still applies. It's just the number that's going to be pulled now for the definition of what a participant is changed, but the 80-120 rule is still intact.
Thanks, Alex. And one more quick question on that. Can a plan that was audited now change to a non-audited plan because of the new rules now that they have less than 100 with account balances?
Yes. So it's not just for new plans that are incepting, it's for all plans basically. So this rule applies for everyone. So if you've been audited all these years and now all of a sudden you find out, okay, you do have still over 100 eligibles, but you have less than 100 account balances, then you're not going to need an audit if as of 1/1 you were less than 100. So and one other thing. So for plans that are newly incepted in 2023. So if you're setting up a plan, it starts in 2023, you don't have a beginning of year, your beginning of year is going to be 0. The valuation of whether or not you're going to need an audit is going to be based on end of year count for that first year during this transition period. Starting in 2024, going forward, it'll be different. But for that inception year, it's going to be end of year to determine that whether you need an audit or not. Good stuff. So Department of Labor study. So the Department of Labor has done this study for years, right? In 1988, they performed a study. The most recent one was 2014. And you could see they are basically looking at the overall deficiency percentage of audits in general. So what they did back in 2014 was they took a pool of 400 plans of all shapes and sizes across the country. And they looked at what is the deficiency rate for these audits. And back in 88, it was 23%, went down to 19% in 97, up to 33% in 2004, and then a staggering 39% in 2014. So when we talk about scrutiny, we talk about peer review, we talk about DL inspection, the results of all that happening now is because of this. You know, the DOL did this study and found, you know, this staggering 39% deficiency rate for percentage of engagement selected with major deficiencies. So it's not minor deficiencies even, you're talking a major deficiency was noted in 39% of the plans that they looked at.
We might cover this later, Alex, but what happens if someone like the Department of Labor were to come in and see that we have a major deficiency or that the auditor had a major deficiency? Why is this important?
It's important because, you know, if there might be re-audits that come about because of this. So the Department of Labor has access to 5,500 data across the board, and we will get into that. But there is an ultimate situation where your plan might have been audited by a firm that's inexperienced, and your audit may need to be re-audited because they found major deficiencies, issues, and not only that, but you might be opening the door to a DOL investigation for them to come in and actually investigate your plan. If not only do they see that you had an inexperienced auditor hired to perform the audit, but if they're starting to look and scour through your 5,500s for past years and see issues come about, you know, in that environment, just looking through 5,500s, and you know, they're not going to send a DOL investigator if they don't think they're going to find things, because they're spending money to get a DOL investigator in there and doing the investigation themselves. So they're going to sift through and filter out and filter for plans that they know are likely going to have issues. Here's another way to look at it. So this is in table format, and you can see there's a direct correlation between the quality of the audits that are done and the experience of the actual auditors. So if you look here at the top of the table, you see number of plans audited by firms when they're doing one or two audits. They found a 75.8% deficiency rate on these audits. You can see the number of firms that were in that bucket and the number of audits that they performed. So close to 5,000 plans were audited by firms that were done by ones and twosies, right? So 75.8% deficiency rate is incredible, right? It's like you're basically going to have a deficient audit for if you have an auditor that comes in that has only one or two plans in the books, right? If you look at the opposite end of that table, once you get from 100, you hire a CPA that does 100 or more, your deficiency rate goes down. It goes down to 12%. It's not, you know, what we ideally would want to see. We wouldn't want to see 12% major deficiencies, right? Or deficiencies with their audits, but it's a lot better than 75%, right? And so you really, as you're going down that scale, you really, even in the 25 to 99 range, it's still pretty high at 41.5%. So when you're asking the questions and you're looking to hire an auditor, a big question to ask is how many plans do you audit as a firm? You know, it's such a clear cut, you know, table. And that's why we like to show it, because the DOL put this out, and the DOL is currently doing a study now. They're rolling a fresh study out this year, and it should come out within a few months. So we're hoping to see these numbers go down after the work that they've put in and the CPA world and the industry has put in to make these audits a little more better, basically, compared to that when that study rolled out. And so ultimately, we touched on this earlier, but here it is. What's the potential risk, right? At the end of the day, we look at that last point, potential rejection of Form 5500 filing. There's so much that goes into an audit to begin with. You know, you've got time usage from the HR team, the finance team. You've got the decision and to bring in a CPA. The CPA comes in and performs the audit. So after all this, money goes out to pay the CPA, right? And after all this, if you end up getting a rejected filing, to have to go back and do that again, maybe you've switched at that point record keepers, you switched your payroll provider, and now to have to go back and redo it and hire an experienced firm to handle it, it's just, the costs just end up and the time ends up snowballing into something that you don't want. So that's really the potential risk there. Audit quality study results reveal the importance of experience and expertise at the bottom of the screen. That's really, in summary, what we're talking about here. Firms that perform more plan audits annually have fewer deficient audits. So when we're requesting for a proposal, what should be asked? What are the questions? You know, this is your first time going through this. You don't know what you don't know. What should a plan sponsor ask of CPAs when they're looking to hire a firm? So we touched on it earlier, right? Number of types of plans that the CPA audits, right? You might have a situation where you've got a national firm that you're talking to, and maybe you're calling on the local office. If the local office works in a silo and they're not really collaborating with the entire team nationwide, it's important to ask, okay, what type of expertise does that local office have? How many plans does that local office do? Is it one partner that heads it all up, or do they have a number of partners that focus on this space? So that's a nuance that is good to ask. We have 50 plus people at our firm. We're all collaborating with each other. It's out of one central office. So those are important questions to ask. Amount of plan specific training the CPA has. So as CPAs, we have to have 80 hours of CPE under our belt every 2 years, right? So as an EDP specialist amongst all our CPAs in our firm, where are we going to put our time in? Where are we going to put our education in? It's going to be in the EDP space because this is what we do all the time. If you're working with a generalist or a firm that is a traditional firm that has, you know, CPAs that do all sorts of services, they're going to put their time in where they're specialized, right? So most of the time it's going to be in corporate financial statement audit. If they have a niche in manufacturing or construction or nonprofit, that's where they're going to spend most of their time in within the financial audit sector, not really the 401k space. The 401k space in general, it's lower margin work compared to the higher risk financial statement audit. So people are going to spend time educating themselves, getting themselves up to speed on those areas that are higher risk for them. And so the 401k is not going to be as, valued when it comes to, putting your time into the education, sitting in on webinars, going to conferences, things like that. So that's also an important question to ask is the amount of plan specific training that their staff is exposed to from year to year. Firm commitment to plan audits. What percentage of the firm revenue is from EBP? Another good question. Specific team experience, who will work on your audit, right? So, if you work with a traditional firm, they might be, staffing the 401k work with interns or first year staff and using it as a training ground to give them enough training on the audit side to get them ready for those higher risk audits down the road, right? So you might end up with, repetitive questions, a changeover in the team every single year with first year staff, interns asking the same questions over and over again. Whereas with an experienced specialized firm, you're going to talk to the A, type staff and team every year because this is all that we do, right? And you're going to talk to at least a 2, 3, 4, 5 year experience individual. You're not going to have a green staff intern actually doing the day-to-day work on your audits when you're working with a specialized firm like ours. Firm membership in the AICPA EDP Audit Quality Center, are they a member of that AICPA EDP Audit Quality Center is a question that you ask because it's another just kind of bullet point to see if they really are active in the space. It's a resourceful thing for us to be part of it because the AICPA will provide resources for those that are specialists with information that'll help our practice in different ways. So that's why it's important to ask. Status of CPA license. So, question on that. So once you ask who the team members will be, making sure that they have a clear and solid ground and CPA license that's still active without any issues there. Whether the CPA has been subject to any DOL findings. So as the DOL comes in and does investigation of the CPA firm's work papers, have any issues come out of that? Has the firm been peer reviewed, and can you provide a peer review report showing a clean opinion from a peer reviewer? Did the EVP side of the practice get peer reviewed? Those are questions that you want to ask as well. And then audit fee, a qualified plan expense. So, plan sponsors shouldn't be overpaying. There's been a lot of lawsuits about, reasonable fees and 401k plans. So an audit shouldn't cost, 20K plus for a basic CPA or basic plan, designed plan. So you want to make sure that you're not overpaying, but you also want to make sure you're not underpaying as well. And because sometimes you get what you pay for, right? So make sure you do your due diligence, that you're shopping around, that you feel comfortable with the fee, and that you're getting what you're paying for at the end of the day. Because that's what you want. You want to make sure that you're getting good quality service for what you're paying. On this slide, so there's a standard that came out, SAS 136, and it changed a little bit of the lingo when it comes to our world and how we speak. So most of you have heard, especially if you're a service provider, have heard the term limited scope versus full scope audits, right? Limited scope, it doesn't mean we're not doing a lot of work. We're still doing a lot of work. It just means that we're not looking at the investments and testing the investments. And it's a banking institution that provides a complete and accurate certification that allows us to perform a limited scope audit. So that terminology, limited scope, with the latest standards was changed to where now we call it a 103A3C audit. So your engagement letters, your audit opinions within the financial statement report are going to show this term of 103A3C. And so when you see it, just know it's nothing new. It's still a limited scope audit. They use them interchangeably. It's just that now with the new standards, this is what they're calling it. The new standards made everything, simplified everything, made it more transparent for readers and clients, so that there's not a lot of CPA type jargon there, and it's a lot clearer. So we believe that the SAS 136 and this new standard simplified and made things better. But this terminology, it's a tongue twister, limited scope versus 103A3C, but just know that they're interchangeable. And when somebody says limited scope or 103A3C, that's what it means. Most audits out there are going to be limited scope in nature, because most plans are designed with a record keeper that can provide a complete and accurate certification. So it's important to know what kind of audit is being done on your plan. Is it a limited scope or full scope? And what does that mean? And so really it's when you're talking about full scope, the only thing that you're adding is testing of investment. And the reason why most are limited scope is because if you think about it, the investments in a 401k plan are going to be audited by a national firm when they're looking at, the principals, the ADPs, Fidelities, Empower, Transamerica, these large companies that are providing this pool of funds for the 401k plan. They're going to be looked at by a national CPA firm at that level. So why would you want to have thousands of auditors looking at 401k plans, looking at these same exact investments for valuation purposes when they're already looked at, at a higher level? So it's just redundancy. So what do we care about most? We care about looking at the participant accounts and making sure that the plan is operating the way it should from a plan document perspective, right? So making sure the company's following the plan document, and we're looking at participant transactions, we're looking at contributions, distributions, vesting, participant data, and anything else that doesn't really directly pertain to investment valuation, all that is still in scope. So there's a lot that gets done with these audits.
All right. So how can we leverage service providers as the plan sponsor, and who are the key players that are involved with the plan typically? So a lot of plans have a financial advisor that's involved with the plan. They're there to help with plan committee meeting minutes. They help review investment performance. They may be, helping or taking some of the fiduciary responsibility off of the plan sponsor. Really, they're kind of what we call the quarterback of the plan. They're the one that's kind of driving some of these investment decisions, maybe some basic plan design changes to help with participation of employees at the company, getting them to start deferring some of their paychecks into the plan. We've got the TPA or third party administrator, and they're involved with what we call unbundled plans. So you'll have the record keeper or service provider separate from the third party administrator that's performing the administration for the plan. Alternatively, the record keeper can be a bundled plan where they're actually performing similar functions that a third party administrator would perform. So we see a pretty even mix of both plans that are bundled with a service provider and then unbundled with a third party administrator. And those third party administrators, they're going to be maintaining plan documents. They're going to be helping the plan sponsor execute any new plan documents, whether it be a restatement of their current plan document or adding some basic amendments to the plan. They're going to be helping prepare the annual Form 5500 and the non-discrimination testing that's performed at the end of the year. You plan sponsors on the call, I'm sure you've probably just recently submitted some census test work for your TPAs or your record keepers to perform. So that's what we're talking about when we talk about the non-discrimination testing. And then they might also be involved with some participant related transactions. So loans and distributions, a lot of times we see that the TPA is involved with reviewing and helping approve those transactions, just making sure there's a second level of review separate from the plan sponsor, the record keeper, to make sure that those loan or distribution transactions are in accordance with the plan document. We've got the record keeper or custodian. All plans are going to have one of those. This is where participants are holding their investments. This is usually where they log in to potentially change their deferral elections or change the type of investments that they're investing in that have been provided to the plan based on what maybe the plan sponsor has chosen from an investment lineup or what the financial advisor has advised for. And then we have the plan sponsor. This is you. Your involvement with this plan or with this audit, at least, is going to be sometimes preparing the deposit schedule, although there are quite decent reports from a lot of record keepers now that we can obtain directly from them using auditors access that allow us to kind of take that burden away from you. You'll be providing, at least in the first year, a copy of the fidelity bond, and that's just the insurance coverage for the plan. And then some major items are going to be payroll registers from the plan year under audit, and then some personnel files from some of our testing selections. So here is a pretty basic list of our required documents. We call this a PBC schedule or prepared by client schedule, although you do see that we have 3 columns there, one for the plan sponsor, one for the record keeper, and then one for the TPA if applicable. A lot of these items can be obtained directly from either the record keeper or TPA. Again, most of the items coming from the plan sponsor are going to be related to HR payroll requests. Starting off there, we've got a list of plan documents that we need to see. And this is really important to obtain at the beginning of the audit, because this is essentially what's driving your plan. This is the structure of your plan. And really one of the main reasons why an auditor is coming in to take a look at your plan is to make sure that the plan is operating in accordance with the plan document. So that's going to be your adoption agreement, any restatements or amendments. We've also got a basic plan document and an IRS opinion letter or determination letter. The IRS letter just basically stating that you're getting the IRS's blessing over the design of this plan and its provisions. And then a summary plan description, and that's kind of what it sounds like, is it's just a basic summary of what the plan's provisions
are based on what the adoption agreement and amendments are. Some meeting minutes, this can sometimes come from the plan sponsor, sometimes the third-party administrator, and then also from the advisor as well, if there is one in place on the plan. And this isn't a requirement for plan sponsors to keep meeting minutes, although it is a very highly stressed best practice, mostly because this is going to be an example of the fiduciary responsibility that you're overseeing the plan. This is going to highlight that. It's going to document any considerations that you've had for plan changes, and whether or not you choose to make them, at least it's showing some level of involvement with the plan if the Department of Labor were to come in. Items 7 through 11 there, we've got auditors package from the record keeper. At the beginning of an audit, the auditor should request auditors access to your record keeper. What that does is it allows them to go in and circumvent the plan sponsor and really, download the reports that are necessary to conduct the audit, any ad hoc reports that are needed in case there's some more investigation that needs to be done. But, looking at pension insurance, last year we did, I think, over 750 audits with numerous service providers. And so we're very familiar with how a lot of these look. These websites, these plan sponsor websites look, and then also what the audit packages look like as well. So we'll go in there, we'll download the audit package, we'll download the participant reports, the plan level trust statements, and which we'll use to build out our audit binders, make our sample selections, populate the trial balance, and draft the financial statements for the plan sponsor. The SSA 18 report, Alex had kind of mentioned it, where you've got a national firm coming in and taking a look at these record keepers. This SSA 18 report, and again, coming most likely directly from the record keeper, usually posted on their site for auditors to download. And this just allows us to look at the controls that were tested at the record keeper level by a separate auditor, and allows us to document our considerations of those controls, making sure they have controls over enrollments or contributions or distributions, physical, logical, access, change management controls, just making sure there's nothing that the other auditor of the record keeper notified or noticed or documented where we would need to alter the nature, timing, and extent of our audit process. We've got a schedule of deposits, and I'll show you an example of that in just a second. But a schedule of deposits to the plan by pay period. We look at this for timing of contributions. We also look at this to test the completeness and accuracy of the deposits that made it into the plan. Apologize, I skipped the non-discrimination testing, usually coming from the record keeper or the third-party administrator. We test that for completeness and accuracy as well. Make sure that if there's any potential accruals that are needed as of year end for any failed non-discrimination testing, that those are included on the financial statements. And then some other plan-specific information, if they're applicable. Is there a discretionary matching formula? Was there an annual contribution or profit-sharing contribution that was made at the end of the year? Is there a true-up calculation if compensation is calculated on an annual basis as opposed to a pay period basis? And then those last two items there, probably some of the more important ones coming from the plan sponsor, the year-to-date payroll register, and then the last paycheck register of the plan year, allowing us to test that completeness and accuracy of that deposit schedule. I know we're getting close to time, so I'll try and wrap it up quickly. Here is kind of a similar PBC schedule, but this is just for new audits. So new audits to pension assurance. This is basically depending on whether the plan was audited in the past or if this is just a recent small plan going to a large filer and this is their first audit that they're ever going through. This is just a list of the items that we need to document our considerations over beginning balances. If a predecessor auditor audited this in the past year, we review their work papers, determine if they did sufficient work, determine if the balances that were reported on their report are accurately stated. If this is a brand new audit, never been audited before, we take a look back at previous plan year activity at the participant level, distributions, contributions, even at the plan level, to make sure that everything looks correct and is rolling forward, and we don't have any potential adjustments that need to be made to the PY1 numbers, because the balance sheet is comparative for the current year and the prior year. So here's that sample deposit schedule. And as a plan sponsor, this is probably something that's helpful to keep just on a pay period basis, just kind of showing when the paycheck date was, what the amount of employee deferrals, employer match, or loan repayments if applicable for both of those last two, and then the deposit date of those contributions and loan repayments. We've got a couple of variances there, as you see, and that's pretty typical if you have a plan that has a vesting schedule and related forfeitures, because forfeitures can be used to pay for plan expenses or to offset future company contributions. So a lot of times we'll see a variance between the amount deposited by the company and what was actually withheld from participants or calculated for an employer match, but those forfeitures can be used to offset those employer matching contributions. Again, we can obtain this typically and create it ourselves from the record keeper reports, but it might be helpful for plan sponsors just to kind of see how they're stacking up, like making sure that the money going in agrees to the money that should be going in, and that the days to remittance, meaning the number of days between the paycheck date and the deposit date, are not delinquent. And we'll cover that in just a second. So kind of talking about that beginning balance test work, audit standards require us as auditors to do an evaluation over those opening balances, whether it be to review predecessor work papers or to conduct our own testing to make sure that those balances are accurate as of the prior year. I won't get too much into the details here, but essentially what we're doing is required and something that's used to determine that the plan is not materially misstated going forward. So I know we're short on time. So common audit findings, late contributions. This is probably the most frequent and common one that we see. And again, going back to that deposit schedule, and this is why it's important to pay attention to those days to remittance, because for a large plan filer, the rule is that contributions need to be remitted as soon as administratively feasible, but in no event later than the 15th business day of the subsequent month in which they were withheld. So it's a little bit vague. There is like a bright red line there, the 15th business day of the subsequent month, in which auditors have to call them out as late remittances. But the Department of Labor is going to come in, if they were to come in and look at the plan and say, your typical remittances are between 3 and 5 business days, and you've got several that are 10, 12, 15 business days, although not past that 15th business day of the subsequent month, they're certainly not as soon as administratively feasible, because you've demonstrated throughout the year that you can do it between 3 and 5 business days. So there really isn't any strong guidance out there on determining what needs to be called out as a late remittance. But just know that at least expect from a question from your auditor if you do have some outliers there from your normal remittance schedule between the paycheck date and the deposit date. Not following the plan document. Again, the plan document is going to lay out everything on how this plan needs to be functioning. It's going to talk about the definition of plan compensation, what's included for that or what's excluded for that. The audit test should cover that. They do it pension insurance, but your auditor should be testing to make sure that the definition of compensation is being used correctly. You've got eligibility, you've got vesting, that the type of distributions that can be taken, whether or not distributions can be taken in service for hardships or for individuals that are typically at 59 and a half years old and still active employees. So we take a look at that as well. And then not following let me back up on that real quick, but the definition of plan compensation, I noted that late contributions was probably the most common definition of plan compensation. If that's not correct, that tends to be the most expensive. So that's one to really really nailed down. Late contributions, corrections are typically pennies on the dollar. Definition of plan compensation, depending on how long the error has gone on and depending on the amount of compensation that's been earned and not deferred on or matched on, will determine what that corrective contribution from the plan sponsor is going to be. And that's going to include up to 50% of the employee deferrals that were missed and 100% of the match. So that tends to be the most expensive one. So if anyone does have any questions, please reach out and we can definitely go through and talk about definition of compensation for your plan and what's being included or excluded. And then not following participant instructions, deferral elections, how much did the participant elect to defer? How much was withheld? If they elected to defer 5% and the plan sponsor is only withholding 3%, that's a missed deferral of 2%. And again, the plan sponsor is going to be on the hook for making a corrective contribution to affected participants for that. And then, similarly to enrollment or auto enrollment, you want to make sure that participants who are eligible to receive benefits are able to enroll and are not improperly excluded from the plan, especially with auto enrollment plans. So thankfully, auto enrollment has a pretty long correction window in which you can just automatically enroll them. I think you have until the 9.5 months after year end in which the failure of automatic enrollment occurred. So you do have a long time to just auto enroll them before having to make a corrective contribution, but that's a large one as well. A couple more slides here, but audit timeline here at Pension Assurance, we shoot for about a 6-week timeline from start to finish. And when I say start, that's once we obtain the audit package from the record keeper. During the first couple of weeks, we'll be looking at the audit package. We'll be populating our work papers, making our sample selections, drafting financial statements, and sending out requests to the client. We'll be doing a risk assessment. We'll be talking about internal controls with the client. Usually that's about an hour-long call. And then weeks 3 to 4, this is kind of where we're wrapping up our testing. We're following up on any exceptions that we found or any open items that we need to complete our documentation within the audit file. And then weeks 5 to 6, this is kind of where we're wrapping up. The audit is going through the channels of review at the firm. Typically, there's a manager that reviews the initial work, a practice leader or a partner that's performing a technical review above the manager. And then again, we're going to have a partner that's doing at least a secondary review of the financial statement. If there is a practice leader performing the technical review, the partner is going to come in and look at some of the higher risk areas within the audit as well. So multiple levels of review that go on in those last couple of weeks.
Chris, one thing I wanted to mention there, it's so important to highlight the fact that there's really a team that handles this whole project and engagement for you. So there's, staff, preparers, manager, practice leader, partner. There's a team that's looking at your file. So by the time you get your financial statements, your draft, it's going to be as clean as possible so that, you can review, give your any updates, changes you want to make specifically to your plan, bounce those off of us before they get finalized. So it's not just a one, individual sole practitioner type environment where you got one person doing everything from A to Z, right? So I think that's important to highlight there.
Thanks, Alex. Major correlations with audit quality. This is kind of just highlighting pension assurance now as we're kind of towards the end here and recapping. Does the auditor audit more than 100 plans annually? Last year we did 750. How much of the firm's revenue is derived from benefit plan audits? If it's greater than 10%, good. But here at Pension Assurance, 100% of our revenue is derived from the auditing of benefit plans. And then the engagement partners, how much CPE or how devoted are they to benefit plan audits? Like where is their training focused on? And here at the firm, not only the partners, but all professionals are required to do somewhere between 40 to 60 hours annually of
employee benefit plan audit specific training. I think close to half of the firm is going to be attending the annual AICPA Employee Benefit Plan Audit Conference this year. And that's really for managers and above, and then also other CPAs looking for CPE as well. But we really stress the importance of obtaining benefit plan audit specific training, because again, that's all we do. That's where 100% of our work focus is, and that's where the majority of our continuing education focus should be as well. And then a little bit more about pension insurance. We hire experienced professionals. We typically hire anyone with 2 or more years of experience. A lot of times we're hiring managers or practice leaders from other firms that have also chosen to dedicate their career to this specialization. However, maybe their firm is winding down their benefit plan audit practice, or maybe they're just wanting to have the next level of expertise and involvement with benefit plan audits rather than potentially rolling off onto other engagements or tax work. They've chosen to come here and really specialize going forward. We have industry competitive fees. I think the greatest value proposition is not necessarily that we have the lowest fees, but the amount of expertise and value that we bring to the audit for the competitive fee that we have. It's an efficient and streamlined audit approach. Again, we've done 750 of these last year. We're very familiar with a lot of the major reporting packages, even the one-off ones. We've been doing those for years as well. So we really try our best to leave the plan sponsor out of it as much as possible and allow us to go in and download the reports that we need and really bring in the plan sponsor in the important areas. So this will just alleviate any additional time or headache or frustration that they might have when going in and trying to look at things that they don't look at on a daily basis when we do. And then again, this is our exclusive focus. Everyone here at the firm, with the exception of the admin staff, are focused on benefit plan audits. So I will add one more thing real quick. It's not on here, but we do try and take a non-adversarial approach as auditors. Everything in benefit plan audits is correctable. So we're really here to help the plan sponsor, make sure that the plan is functioning correctly. And if there is anything that we do identify, really bring it up, let them know, hey, this is what needs to be fixed, and get them in touch with the correct people to help them go about fixing that. So thanks, everyone. Really appreciate you sticking in there. I know we went a little bit over time. We've got some contact information for me and Alex here if you want to jot that down or write that down. If you do have any questions or additional questions, please let me know. We'll be sending out the slides. I should have most of everyone's emails. We'll be sending out the slides or the recording for this presentation. So thanks for attending. We really appreciate you taking your time on a Friday. If you do have any questions at all, whether it be from a service provider side or from the plan sponsor side, please don't hesitate to reach out to either one of us.
We had